We'll go ahead and get started to be respectful of everybody's time this morning. I'm really excited to be joined today by a good friend of mine and colleague, John Coker. John is a partner at Wilson Coker Wealth Advisors, and John and I have been friends for quite a while now, a number of years. He's not just a financial advisor, he does carry the designation of a CFP, so he's a certified financial planner. And John's culture at his company is one that means a lot to his clients because the way they look at the client's business is really the entire picture, right? It's not just looking at a small portion of a portfolio or doing stock brokerage and things like that. Although being a broker is a part of that larger picture, but he's really viewed as a trusted partner to his clients for their ongoing success. So my name is Christian Baldwin. I'm the Managing Director at Black Diamond Mergers and Acquisitions. We are set up to do quarterly webinars with educational topics, and today we want to talk about how we enter into a deal and a deal team where we've got a financial advisor or someone in John's capacity as a part of our deal team in order to make sure the clients reinvesting of their proceeds when they sell a business are going to be used at the maximum value and potential. Our process is really a simple 5-step process where we start with trying to learn a client's business, what their objectives are. We customize that plan. We execute it when we're selling their company, trying to make sure that we take that and incorporate that into their overall plan, and then we close the transaction. And then my favorite part is that we celebrate that as we transition what they've worked so hard for many times, 20, 30 years or multiple generations even in certain family scenarios. So, John, when do you think is the right time to add that financial advisor to the deal team?
Well, I mean, that's really dependent upon each particular client and what their needs are. But, I would say, to really get that full 50,000 foot view picture, if you can start within 12 to 24 months prior to actually that transition occurring, you can really start to put that personal picture in play and really analyze that entire financial estate for each family and determine how does that business sale work in relation to the rest of the financial estate. So the more time we have, the more time that we can really get that picture, be as detailed as possible, and then really drill down to customize for each particular person. So, I'd say, the longer the better, but in general, I'd say 12 to 24 months.
That's great. Sometimes the client may not really even think about what they're going to do next because they're still running a day-to-day business, right? They have all these things that they have to deal with. Normally our deal teams are comprised of someone on our side from our team that's leading the M&A work, a corporate attorney or business attorney, an accountant that is familiar with the financials of the business. Sometimes the financial advisor and even the insurance role are roles that should be added sooner rather than later for those things. How often do you get to the situation where your conversations and your expertise and what they're asking you leads into multi-generational? And what I mean by that is, okay, the business owner is going to exit the business. They may have a windfall of cash coming in. Do they incorporate that information to their own trust planning and their wills and their estates and that sort of stuff?
Yeah, absolutely. I mean, and that's where we like to come alongside their estate planning attorney. And, we don't try to play attorney and give legal advice or anything like that, but whatever that plan is drawn up by their estate planning team, it's our job, especially on the financial piece, to make sure that all that stuff is funded. So if they have a trust, making sure that if sale proceeds come out, that it's going into the trust, and that way it's funded. If you don't do that, then the trust doesn't work as well as it's supposed to. It's actually could be in a probate situation from what I understand. If there's a family partnership or even looking at beneficiaries for like an IRA, just making sure that all of those things that the attorney has put in place, that we're actually executing that and being and really doing our part as a professional member of the team there.
Yeah, it seems like it's some experience we've had together that, the client may say, okay, what are my options, right? And then everybody can go do their respective research and come back to the table and say, okay, look, from a legal point of view, these are, you know, 1, 2, or 3 things that we should consider. And they're all interrelated when you're selling a business, down to structure and tax implications, and then how you reinvest those proceeds. So it's all really, you know, they all come together, but each individual person that's at the table has a certain area of expertise, and you know, having you there to kind of guide those discussions is great. Someone in your capacity. What options do business owners in general have for reinvesting their proceeds? It's normal for a business owner to have a thought process of, okay, how am I going to make this investment, whatever that is. But usually at that point, before they exit, most of those thoughts have been related to the assets of their own company. Now, if they take those assets and they're transitioning them out, what are some options that they have to think about how they're going to reinvest?
Yeah, I mean, you know, it could be a lot of different things. I mean, as you know, a lot of people may decide to reinvest into another business. They may decide to actually take some of that in cash or a combination of the two. And so it's really our job to really look at their entire financial plan and say, what are their goals? What kind of income do they need from those assets? And really, you know, looking at it from an after-tax perspective. So we can't count on those part of that money because they're potentially going to have some taxes due. But let's say that they need $30,000 a year from those proceeds. How do we do that in a way that we can generate that in a safe, conservative manner, but also still give them some growth, because they're going to need to keep pace with inflation and make that money last for as long as possible. So, you know, we would work with each particular person, and you know, if we have a longer time horizon, maybe that's a portfolio that's kind of middle of the road. Maybe you got 50-50 or 65% stocks. You know, maybe you have somebody that's just going fully retired and they just want, you know, 4 or 5% income, and maybe they have a more conservative portfolio that has more bonds. And so, you know, from a process standpoint, it's really what are the particular needs for each person, and then we use our tools to kind of plug in that investment piece to make sure that we're helping them achieve those goals.
What do you think about using 1031s or, you know, deferred sales trusts or any of those other, you know, tax advantage or tax sheltering options or tools that may or may not be applicable in, you know, in certain circumstances? How do you guide clients through those different scenarios?
Yeah, I mean, that's really something that they would work more with their CPA and or attorney on. I know you guys do some guidance on that. You know, from our side, if there's a specific deferred sales trust or anything that we need to execute on our end, we will do that. But if we recognize that that's something that's a potential opportunity, we'll basically try to partner and work with your team or any of the other professionals to kind of give guidance there.
Yeah, I've seen in a few different scenarios. If you have, a lot of times you'll have a business that has, you know, real estate owned by the same ownership structure, and it's a simple lease scenario from the operating business back to the real estate. Although the ownerships, you know, could be the same in both cases. In those scenarios, sometimes business owners want to use a 1031 exchange for the real estate portion, and then you know, of course, you have to use a qualified intermediary, and you can't really touch the funds if you're the seller until they're reinvested, and then you can defer those taxes. So for real estate, that can be a good option to consider. Mm-hmm. A deferred sales trust is a little different in that, and this is where you really need your accountant and lawyer to really, you know, look at the fine details of it. But just in general, you know, where you set up a third-party trust. It's a legitimate trust administered by, you know, a trustee, and you sell your business or assets into that trust, and then the buyer comes in and buys them from the trust instead of from you as the owner, and then you have an installment contract or something that pays out over time. The advantage of doing that can be deferring capital gains on the sale of the assets that you might otherwise have been hit with. But it depends on the needs of the owner, because going back to the financial planning part of it, if you're going to set up an installment contract to defer those capital gains, then you want to make sure that, you know, whether it's monthly or annual income levels are still achieved, right?
Correct. And that's a good point. I mean, you know, if you've got a certain amount of money coming in from a deferred sales trust, or if you've 1031 some real estate that's going to have maybe some rental income, you know, that's one of the things that our planning software does. Is a lot of times for a lot of clients, their income sources come from 3, 4, 5 different areas. And so that would be just where we plug in. You've got $20,000 coming from real estate, 20,000 or 30,000 coming from a deferred sales trust, Social Security, investment assets, trust assets, IRAs, and really put it all into a program and say, hey, what are our chances of success? Are we on track, or do we need to make some adjustments there? So whatever that situation is, we can blend that in and really, again, customize towards what we're trying to do for each particular client.
You ever have a situation where somebody comes to you and they say, hey, this is what I want to achieve in terms of recurring, income off of my proceeds that just isn't feasible?
Yeah, I mean, and in that case, you have to really kind of think through and determine, do I want to take a little bit more risk to do that? Are there some adjustments that I can make as far as spending goals? In some cases where I see people that retire, but then they, go and work as a consultant or something like that for extra income to bridge that gap, to give them the ability to continue to practice and have a daily routine. So, yeah, it's just really kind of trying to talk through and say, this is something that might work, but it's going to be kind of a stretch, and what are some things that we can potentially work through there?
What about a business that has 2 or more owners? Okay, so their structure can be different. Are their options the same, or do they each have different options based on their structure?
Yeah, it's
ownership proceedings.
very common, and again, each owner, even though they might have the same ownership interest, like let's say they're a 50-50 owner in the company and they have the same proceeds coming out, more than likely they're going to have a very different family dynamic and financial goals. And so, our job would be to understand what are the dynamics for family 1, and then what are the dynamics for family 2. And more than likely, the recommendations are going to be very, very different for each person. The process will be the same, but the recommendations are going to be different to try to achieve each family's goals there.
Do you have any examples of how you've done that and kind of manage the family dynamics? And when you get into family money, I know that can be a touchy subject,
Mm-hmm.
right? Especially when you get into certain children may have expectations and that sort of stuff.
Mm-hmm.
How do you deal with the softer side of those conversations to make sure that you're still, meeting all the objectives that they have?
Yeah, I really kind of take the family's lead on that. Some people are more comfortable with some things than other. I would say, communication is probably the biggest key. It's the biggest key for a lot of things in life. But, some of the more successful dynamics that I've seen is where slowly but surely, kids or grandkids, they're kind of brought into the process to kind of understand, what the family estate looks like, and then how is it going to work going forward. So to me, that's where I've seen the most success. And not that the other way around is necessarily bad, but in some cases, a second generation or a third generation can be maybe a little overwhelmed or a little blindsided further on down the line. So I'd say, the more communication, the better, but again, it really depends on each particular family and what they're most comfortable with.
I agree with you on the generational perspectives. We're seeing more now than I used to see, where the second generation, for a family business that's done really well over time, they're very hesitant to transition the business to the next generation. And it's not really because they don't trust the next generation at all. It's that they don't want that generation to have the business become a divisive issue in their family. And it took me a little while to really understand that. But let's say you've got a business that mom and dad started years and years ago, and now they've got 2 brothers or sisters that are running the company, and they saw the hard work, right, that the mom and dad put into it, and now they've done a good job growing it even further. And some of these are very successful, profitable businesses, but those current owners don't really want to see the next level own the company, because they've seen some of the dynamics in the family business itself, and while they may have been very successful, they don't want to put that on them. They'd rather sell now and convert to cash, and then use that and say, okay, look, we're not going to give you the business, but we're gonna work and sell the company, and then have that be what we give you, you know, as a part of our estate planning, right?
Sure.
And heading it down that way, and, you know, I guess it makes sense, they don't want any negative guilt associated with it when they step away from the business at some point in the future. And that way they can say, look, you know, we think we did the right thing for our family, which is an interesting perspective that I see going on right now, and kind of low to mid-market sized companies. From your company, okay, Wilson Coker, what does the financial planning process look like that you guys use, and how does that impact somebody that may be selling a business?
Yeah, I mean, so that's the process. It's going to take us several months to really build a plan, and the more complex the estate, the longer it's going to take. But, you know, again, I mean, it's really starting at, you know, kind of looking at a personal financial statement, kind of an inventory of your financial estate, looking at, so, you know, assets and liabilities, income, but on top of that, looking at all the different types of insurance that you may have, whether it's life insurance. You know, we look at, we work with our insurance professionals to see where they are on their liability limits. You know, do they have good liability limits? Do they have an umbrella policy? For a lot of families, long-term care planning is is becoming vastly more important. Our society is living longer, and the need for that type of planning is getting greater. And then their estate plan, and, you know, determining where they are on that, what have they done, what do they potentially need to do, and then really kind of putting that all into a software and saying, okay, based on everything, what's our probability of success of achieving those goals and maintaining the standard of living and hopefully increasing that standard of living. So, you know, that's really what the process is. And so because it takes a lot of time and we got to make, you know, a lot of data entry and adjustments, you know, you asked the question earlier about, you know, when's a good time. That's why we say kind of 12 to 24 months. And my hope is that when you see that, it allows that particular person more clarity with their financial situation so that they can make maybe the decision to sell a business or another decision within their financial estate. And so that's what the process is designed to do, is just give you some clarity, let you kind of know where you are. And then once we have it in place, we can make small, subtle adjustments and things like that when we do reviews, and, you know, almost kind of become an accountability partner to say, hey, how are we doing? Are we on track? Do we need to have a discussion about making some adjustments?
You mentioned insurance. Insurance is one of those things that, for whatever reason, sometimes it's not even really considered until the very last minute. It's almost an afterthought, right? But it's so important. And doing a deal like, you know, for selling a company, that's a moment in time where insurance needs change overnight, you know, because now all of a sudden they may need less coverage in one area. I mean, they'll need less obviously for the business that they sold. That's going to be picked up by the buyer. But their umbrella, you know, coverage may change. All their other assets may need to be covered differently and that sort of stuff. So that's a great point, I think, in bringing that to the table. You know, as early as we can in the process is going to be, you know, extremely valuable. Just a small side note, right now COVID has really thrown a huge wrench into the insurance industry, and they're trying to get everything sorted out in terms of workers' comp and perceived levels of risk by industry. You know, what do you do with potential workers that may or may not get sick from the employer standpoint and all that? And they're trying to sort all that out through the courts and everything else. But at the end of the day, you know, having the right level of insurance to protect those assets and those family members and, you know, all those things that you have to think about is obviously really, really important. Alongside the financial planning process, are there credentials that someone should consider? How does that play into, you know, trying to pair up the right financial advisor with the client?
Yeah, I mean, that's probably a little subjective, but I mean, I'm probably a little biased. But, you know, certainly if you have a certified financial planner designation, it's kind of like going back to college for 5 or 6 classes. You learn how to use the software better. You learn how to really go in and analyze all those different aspects of wealth management planning. You know, experience in anything is always a good thing, but I'd say probably, you know, one of the most important things is just having the right personality or relationship fit. Sometimes it's just the right fit. And so, I would tell anybody, if you're going through this process, speak with several different people and kind of everybody's going to approach it a little bit different. See what you like, what you don't like, and see what you feel like might be the best fit for you and your family. To me, those are probably the most important things to consider in that process.
That's good advice. So what are a couple of additional examples that you may have used in the past that have seemed to work well? Different investments or suggestions that your clients have really enjoyed working with you on?
Yeah, as far as the investment piece, the bulk of our business, we use fee-based professional money managers, and so that's what we pay our broker-dealer Raymond James for. Is we've got access to some of the best managers in the world, and so it's our job to determine what's the right manager, or sometimes there's multiple managers to put in place to help clients achieve those goals. And so I would tell you, we just went through a pretty tough downturn in March. If you're using a disciplined process and a good manager, a lot of them are doing, so we've got several that are positive year to date, or very close to it. And so, you're gonna have ups and downs in the market, but if you use a good manager and a good process, typically you're gonna be able to achieve those goals over time.
Usually the business is the single largest asset on a personal financial statement of a business owner. And what sometimes happens is they almost neglect to bring that to the table and fully allow you to look at that in their total picture, which is one of the things that we said in the beginning that you like to make sure that you fully understand from them, because they may have other investments along the way, right? You could be managing, as a financial advisor, you may be managing a portion of their entire net worth, but here they go selling their largest asset that's going to convert to cash or whatever, and then you have more tools at your disposal, and they still may want you to say, okay, look, John, this is what I'm thinking about doing. My attorney's over here saying that I should use a 1031 for the real estate. We're going to look at Whitetown property and do some income stuff over there. How does that fit in? And then, maybe my accountant's telling me that I should do something over here with some other proceeds. It's not necessarily, I'm going to take 100% of what I get and then just do that one thing with it, right?
Sure, absolutely. Yeah, it's more times than not, it's a blend. It's a blend of everything, and you hit on a good point. A lot of times, we are working for a business owner, and then we get to that point, and they're actually to that sale, and they're going to have a cash infusion, or they're going to do a reinvestment or a combo. A lot of things we do, for business owners too. Before that, it's just helping them determine, do they need to maybe consider a retirement plan for the business. And so sometimes it's helping them do that, and we evolve, but we still have the plan in place. So we kind of build it step by step and brick by brick as we go. So, we're talking about 12 or 24 months, but, we have a lot of people also that we've worked for many years. And so we just kind of help build those components over time, and then if the situation arises where they consider selling the business and they've got a windfall, then we would address that and be able to address it probably a little bit easier, because we've known the family and worked for them for quite some time.
That's great. Well, before we open it up for questions, will you tell us a little bit more about Wilson Coker Wealth Advisors and where you guys are located? We've got people, I think, that have joined from various parts of the country, so they may not be totally familiar with you guys. Tell us a little bit more about how you're set up.
Yeah, so my partner Kevin Wilson started our firm back in 2000. I'm from South Arkansas, and I moved up here in 2004. So I started work, I had an internship with Morgan Stanley, graduate school, and transferred up here and spent a little bit of time with them, and then was recruited away by Merrill Lynch, and it was in 2006, and that's where Kevin and I met, and we actually formed a team there and worked together for a while, and then the recession hit, and we opened an office for Morgan Keegan, which was a Memphis-based firm owned by Regions Financial. And then in 2012, Regions sold Morgan Keegan to Raymond James, and it was at that point we had the option with Raymond James to either remain as an employee of the company or create our own brand. And so we started the process to design and build a commercial office designed for our practice, and actually created Wilson Coker Wealth Advisors in 2015. So while our brand was just established in 2015, the business has been in existence since 2000. And so we're a financial planning based practice. As we've kind of been talking here, that's where we typically recommend you start so we can get that entire picture. And then we use Raymond James as our broker dealer and access to all of our different software and money managers and everything to custom design for each client. And so right now we're at a temporary space here in Rogers. We actually kind of outgrew our other space, bought the lot next door, and it's under construction right now. So we're looking forward to hopefully in December being back just right off Pleasant Grove, very, very close to right next door to where we were before, and just continuing to do as we normally do. So just
Nothing like moving twice.
nothing like moving twice. Not ready to do it again once we complete this one.
That's great. And you mentioned to me earlier, I didn't even realize this, you guys have a satellite office in Camden, is that right?
We do.
Okay.
We actually purchased another business from a bank last year. We've owned it for about a year and a half. We have a great lady down there that is running that. We have a lot of clients in South Arkansas, Central Arkansas. We're licensed in probably, I'd say 15 to 20 states. So typically clients that are somehow have Arkansas ties or a family member that's been referred to us that we work for. And then we also have 2 partner offices in Fort Smith, 2 senior advisors that have been in the business for about 30 years. And they kind of run their own offices, but they're part of our complex. So we have our office here in Northwest Arkansas. This is our main office, and then 3 satellite offices, 2 in Fort Smith and 1 in Camden. So we've got pretty good coverage across the state, and work for people all over, mainly Arkansas in the region, but still have some in other states as well.
That's great. All right, thanks for that overview. Okay, I think what I'll do now is I'm gonna unmute all the participants, and so if you guys have some questions, we're happy to fill those. Let's see.
Everyone else is now unmuted.
Okay, so everybody's unmuted now, so if you have a question, feel free to fire away.
Okay, let me see if I can take.
Any questions out there? I know we weren't that good.
Yeah, I got a question for Mr. Ball in there. This is Bill Welch.
Hey, Bill.
If you're getting ready to work with clients on a sale, what are the 2 or 3, big problem areas that you just wish people would get cleaned up before they got to talk to you?
That's a good question. Yeah, I think financial records would be one, or accounting. Just getting with their accountant or controller if they have one on staff to do any adjusting journal entries and that sort of thing that may need to be cleaned up from prior fiscal years would be one. That's probably the biggest one. Otherwise, a good strategic plan that can be handed over to a buyer would be another one, and we can help them with that. Those are a couple that I can think of.
Thank you.
You're welcome. Good question. Anybody else have any questions out there?
Right.
Stock price, all those.
Anybody else have any questions or comments or anything? Well, if there are no more questions, we won't keep everybody. We'll close this out. I want to, again, thanks so much to John, and happy birthday, by the way.
Yeah, thank you.
Yeah, we appreciate you taking time out on a work day, but also on your birthday to have this. Hopefully you guys found this helpful we have recorded this session, so we'll get it out there online, so if you wanna forward it on, or, go back and listen to it another time, then that's fine too. So, on behalf of Black Diamond Mergers and Acquisitions and Wilson Coker Wealth Advisors, we hope everybody has a great afternoon, and we're always here for you, whether you're looking to buy a company, sell a company, reinvest your money down the road, whatever that is, we look forward to helping you and your family when the time is right. So, y'all take care. Thank you very much.
Thank you.